Have you ever used any subscription services from any of these companies, like Zoom, Microsoft, DocuSign, Evernote, The Economist, and Autodesk? If yes, have you ever wondered how are the billing and revenue collection processes done at the backend, and whether providers of these solutions are good companies to invest in? Today, let's talk about Zuora, the global leader in this field, which powers the subscription system for many Fortune 100 companies and many other technology companies. In particular, we'll be talking about the company's shift to subscription economy, the solutions provided by Zuora, its revenue model, the market size and competition, the financials, some challenges and changes in strategy done by Zuora recently, its valuation, and the risk for this company. Before we start, I would really appreciate if you can help to hit the like and subscribe buttons so that more people will get to know about this company. It takes a long time for us to research these companies in detail and prepare the videos. So your support in hitting that like button will really go a long way in motivating us to produce more videos on good companies. A quick disclaimer first that whatever we are discussing today is not any investment recommendations and should be treated as for educational purposes only. So in this digital world, we are increasingly using subscription products where we see a shift from product to customer-centric model among the companies. Think about ourselves. Instead of buying music CDs in the past, now we are streaming music online for a monthly fee, say using Spotify or Apple Music. And the same goes for movies with Netflix here for everyone. So companies are increasingly realizing that by moving from a product sales model to a subscription model, they get to deliver services to the customers in a way that works better in this digital world. And they also get to understand their customers better. And through subscription, they can keep retaining the customers and keep selling to them, earning revenue from them on a recurring basis, as long as they keep delivering value. So this shift is not happening just among new technology companies, but in many other sectors too, like manufacturing, automobile, media, medical, financial, and government. Just look at the number of companies here in various different industries that are using Zuora's solutions. And here's where Zuora comes in with its mission of helping the world's best companies to win in this shift to the subscription economy, where the demands and success factors for such economy is different from the past. So Zuora, which was founded in 2007, has basically built a central platform to help companies cope and thrive in this subscription economy by helping them to deal with issues relating to billing, revenue recognition and collection, and also data analysis associated with their subscription services. In particular, there are three more popular products that the customers are using now. First, there's Zuora Billing, which allows companies to bill their end customers in many different variations of billings. For example, on an annual or monthly subscription plans, or free trials or discounts for certain periods, bundled promotions, different pricing for different users or product tiers, customized plans, and changes to plans like upgrades or downgrades in the middle of a month are possible too. So these variations, as you can see, can quickly get very complicated in a short time. And that's why companies like Zoom, which used to build its own system to manage all these billings, actually realized that they couldn't do it themselves anymore in a robust and fast way. So they had to use Zuora solutions to allow them the ability to do so in a robust manner and scale fast in this fast-changing world. Besides billing, Zuora also helps customers with the complicated revenue recognitions associated with all these subscription services and revenues and accounting, and also timely automated collection of the outstanding amounts from customers so that the companies get to extract the most revenue from their customers. What's interesting is Zuora's multi-product strategy and revenue model. So when a company first goes with Zuora solution, it has to adopt a central platform and pays a fixed annual central platform fee of about 25,000 to $500,000 to Zuora, depending on the version of that platform with different complexities involved. Then the companies usually start using Zuora's billing solutions, where they will start with a small amount before increasing their committed volume and upgrading to higher value solutions. For these services, the companies actually have to pay variable fees based on the amount of invoice amount or revenue recognized. So when these companies think about when Zoom grows their revenue over time, and Zoom has been growing crazily, then they have to keep paying Zuora more and more. And then as the companies get cross-sold and start using other solutions provided by Zuora, like the revenue solutions, the collect solutions, or the other platform solutions like analytics, then Zuora will just get more and more revenues from the same customer. This actually lead to a high net dollar retention for Zuora, which historically has been more than 100%. This means that every year, the existing clients are paying fees to Zuora that are at least the same, if not higher than what they paid in the previous year. The NDR in financial year 2021 was affected by COVID-19, but was still around 100%. And the company is targeting to increase the NDR up to 115% by financial year 2025, which is the financial year ending in January 2025. So it's almost the whole of calendar year 2024. This high NDR means that the cohorts acquired in different years have been paying more and more fees to Zuora every year, and those fees have compounded at around 20% a year, boosting Zuora's growth. And some large customers even end up paying Zuora up to 30 times of what they paid in the first year. For example, this high-tech company was paying Zuora an annual recurring revenue of 130,000 in 2015 when it first signed up with Zuora. But 6 years later, it was paying Zuora about $4 million of annual recurring revenue, and that's 29 times more than what it initially paid in the first year. And the thing with these building systems is that these systems are very core and central to the company system and are deeply integrated into a company systems. So it's very sticky, just like the traditional ERP system, the enterprise resource planning systems. This means that these customers are likely to stick with Zuora solutions for a long time and will keep paying Zuora more and more over the years, if and when they grow their subscription revenues. If you look at the market size, it's about $5 billion in 2020, and Zuora earned about 300 million in financial year 2021. So it had a market share of about 5%. Now, 5 billion is not very large, but it will continue to grow, and that growth was expected to be about 25 to 30% a year. In this market, the main competitor is in-house systems, which take a long time for the company to develop themselves. And those systems, in-house systems, might work in small scale, but the companies could face more problems as the company grows in scale, which was what happened to Zoom, and that's why Zoom started using Zuora as it expanded rapidly. According to a research by Forrester and also separately by IDC, Zuora is currently the best and the leader in this market, where it has been developing and improving its solutions since 2007, so it has a pretty good head start. The traditional ERP providers like SAP and Oracle NetSuite, and also other smaller competitors which started later, are lagging behind now. So on its financials, from financial year 2016 to financial year 2021, Zuora has been growing its revenue and gross profits pretty well, more than tripling its revenue from 92 million in financial year 2016 to 305 million in financial year 2021. However, it has been loss-making throughout these years as it continued to spend lots of money on R&D and sales and marketing expenses. In financial year 2021, it earned a gross profit of 175 million, which was a 57% gross profit margin, but it spent 77 million on R&D, 117 million on sales and marketing, and 55 million on general and administrative expenses. So it incurred a loss of around 73 million. And also, as you can see here, Zuora's revenue growth has been slowing down, and it has slowed down significantly to 11% in financial year 2021. That is partly because in the past 2 years, in calendar years 2019 and 2020, Zuora had experienced slower growth, where it was dealing with some challenges in integrating its revenue and building solutions together, and also in dealing with the complexity of enterprise selling and deployment. However, the good thing is that the management said that those have now been addressed, and they are ready to pick up the speed of growth again. The management have also re-strategized their enterprise go-to-market strategies, where they now aim to rely more on third-party system integrators like Accenture, Deloitte, IBM, or the regional system integrators to do the selling and deployment of the systems more, usually as part of their broader business transformation projects offered to the clients, instead of taking up most of these works on their own. And between late 2019 and early 2021, Zuora also brought in 3 new management who have come from strong technology companies, where they have contributed a lot in the SaaS transformation or cloud services businesses for those companies like Adobe, Microsoft, Cisco, SAP. And this new management will be able to help Zuora with its product development and enterprise selling side. Now let's look at the share price and valuation. Zuora's share price has come down from around $20 on its IPO date in April 2018 to around $15 now in May 2021. This translates to a market cap of around $2 billion, and it had some net cash at the end of financial year 2021. So the management has set some targets for financial year 2025, targeting 25% subscription revenue growth annually, and a free cash flow margin of 10 to 15%. So let's use some of these numbers in our projections. But let's see if the targeted free cash flow margin is reasonable or not first. In financial year 2021, Zuora made a net loss of 74 million. If we assume that 25% of the R&D spending and 75% of the sales and marketing spending was actually for future growth and were not needed for the maintenance of existing customers, then if Zuora wants to stop growing, it doesn't need to spend those growth spending, and it will be able to achieve an operating profit of 33 million, which translates to an operating profit margin of 11%. So although Zuora will still need to spend some money on capital expenditure, noting that it's actually quite capital light as a technology company, and it also needs to pay some taxes. However, it also has some minor negative working capital from its deferred revenue as it collects its subscription revenues in advance from its customers. Therefore, a targeted free cash flow margin of 10 to 15% by financial year 2025 is not that too far off, particularly if the company does not want to reinvest a lot more by then. So we'll use the high end of 15% for the free cash flow margin in our projections. So here in financial year 2021, Zuora earned a revenue of about 305 million. If we assume that in the next 4 years, it can grow its revenue by 25% a year, then it will reach 746 million of revenue in financial year 2025. With a 15% free cash flow margin, and assuming an enterprise value to free cash flow multiple of 25 times, Zuora will be worth 2.8 billion in terms of enterprise value in financial year 2025. However, we need to discount this value back to today. And if we use a discount rate of 15%, meaning that if we investors want a return of 15% a year from the investment, then after discounting, the enterprise value will be $1.5 billion today. And that translates to a rough value per share of about $10.6 today, which is quite lower than the $15 share price today. However, if Zuora can continue to grow at 25% a year until financial year 2030, while keeping the same free cash flow margin, then it will be worth around $16 per share today. Or if it can grow faster during any of these periods, or maybe if it can achieve higher free cash flow margin, then it will be worth more. Now let's talk about the risks, and I will just highlight 3 of them. First, enterprise sales is not easy, particularly for systems for such core functions like Zuora's, where many departments and senior management team in the client company will actually be involved in the decision, probably together as part of their broader business transformation plans, which is a big milestone for the company. It therefore requires certain skills and strong relationship with the companies that Zuora probably still lacks now due to its scale, and hence its choice to partner with the global system integrators like Deloitte, IBM, Accenture, etc. However, these system integrators do not deal exclusively with Zuora and can promote the solutions of other competitors too. So Zuora, in a sense, will be quite dependent on them promoting its solutions and maintaining the quality of the deployment. Next, the deployment of Zuora's central platform, due to the inherent complexity of such solutions, currently take a long time, sometimes up to 8 months. And Zuora is trying to reduce this now. And any problems could pop up during this long period. Therefore, companies might actually have incentives to go with solutions provided by their existing ERP software vendors. Now, for example, SAP or Oracle, which offers them all these solutions together as a whole suite of integrated solutions. Although currently SAP and Oracle have not really gone aggressively on this market yet. However, if in the future, if they decide to do so, if they decide to focus on this market more and offer good solutions on the subscription billing and revenue recognition and collection solutions, then there will be tough competition to Zuora, purely just due to the skill that they have and the distribution network that they have and the existing relationships they have with the customers. In addition, if many of the companies are not ready to transform to a subscription model yet, then that will slow down the overall industry's growth and by extension, Zuora's growth. So we have covered quite some on Zuora today. If you believe that the world will increasingly shift towards a subscription economy in a fast pace, then investing in Zuora could be a proxy and help you to profit from that industry tailwind and change. So what do you think of this company? Would you buy it? Let us know your thoughts on Zuora in the comments below. And if you have learned something from this video, I would really appreciate if you can help to smash that like button now if you haven't. And do subscribe to our channel too if you want to be notified of future videos on Zuora or other great companies to earn. We have previously covered many great companies that you don't want to miss out. For example, Adyen, Stoneco in the payment space, and also Wix in the SaaS business space. So check them out in our channel if you haven't. Thank you very much for your time, and we'll see you in our next video.
Do join us in our investment forum on Facebook, using the link in the description below, where we discuss lots of interesting businesses and investing concepts. Do check out our Multibagger Research Series at the link in the description below, where we discuss in detail great businesses to own and compound your wealth for the long term. These great businesses have high growth in revenue, profits and free cash flows. For example, this global payments company has grown at a compounded annual growth rate or CAGR of 60 to 80%, while this technology company has grown its revenue at a CAGR of 80%. And this other payments company has grown its revenue and profits at a CAGR of 20+%. Check out our comprehensive option series course on option strategies to complement long-term investing at link in the description below.